This is the truth about SCHD, the Schwab US Dividend ETF that's highly touted on Twitter, highly touted on the internet, and it kind of gets a little frustrating for me, so I'm going to break it down a little bit. There are some truths to it that people are saying on the internet, and there's a lot of misconceptions going. So let's do this entire video. I want you to pay attention if this is something of interest to you that you believe can get rid of all your worries about retirement. Guys, there's a lot of misconceptions about SCHD out there. I'm here to tell you the full truth about SCHD. I'm going to break down some of the math and some of the black or white incorrect facts that people are stating about SCHD. Guys, my name is Paul. I'm a value investor. The Everything Money community calls me Uncle Paul, and I'm here to break down the fundamentals and the process of how I evaluate investments. After I show you the truth about SCHD, I'm then going to share with you what you actually should be doing for retirement that you can start on today. Now, guys, I'm very active on Twitter where SCHD has a lot of attention, and I see posts every single day about it. And if you're active on Twitter, follow me. I do several posts a day. I engage. I love having conversations with people about this. So for SCHD, there's a lot of great stuff with SCHD. It's a dividend payer. It's got a lot of very, very large companies that are not very sexy, which, as you know, I'm a big fan of. And if you don't know that, if you watch more videos, you'll see I prefer to find good fundamental businesses, preferably ones that are boring, because they tend to be less overpriced. Here are some of the major holding of SCHD. You've got Amgen, AbbVie, Chevron, Merck, Broadcom, Pfizer, Cisco, Texas Instruments, PepsiCo, Verizon, UPS, Home Depot. Guys, the list goes on, and these are the weightings. It's a very diversified list of companies, and all of these companies pay a very, very nice dividend. The overall dividend yield for SCHD, it is 3.7%, while the S&P is around 1.2%. So it's triple the dividend yield of the S&P. Now, why is that awesome? Well, unfortunately, a lot of people in the Twitter community, they'll deny this, but they seem to behave like dividends are free money. Spoiler alert, they're not free money. As an example, let's say you owned a business and you have $100,000 in profit for the year for your business, and it sits in your business account. If you paid out $50,000 to yourself, now your business has $50,000 in less money. Therefore, your business is worth $50,000 less, but you have 50 grand in your personal account. Well, I believe the impression I get from people in the Twitter space, and of course I'm gonna get attacked for this, but they seem to act like that's just free money and the company's still worth it. Well, guys, if the bank account's $50,000 less, the company's worth $50,000 less. But when it comes to dividends, the problem is the second you get paid the dividend, you gotta pay taxes on that. Dividends are double taxation. The companies already paid taxes on the money that they were able to put in their account. And then when they paid out to you as an owner, you have to pay taxes again. It's tax inefficient. So that's the first thing I don't like about the whole dividend community. They act like it's free money, and of course they'll deny it till they're blue in the face. But then when I see them analyzing companies, they'll say, hey, look, this company's now paying a 7% dividend. Is it the time to buy? Well, you gotta analyze it. Can the company afford the dividend? Does their free cash flow support that dividend? On our channel, what I like to do is I like to look at let's pull up a company like Amgen. So right here, what we do is we go here and say, okay, great free cash flow here. 9.7 billion last year. In the last 5 years, it's averaged 9.24. They paid 4.35 billion in dividends. All right, seems like it's pretty manageable. This is less than half of their 5-year average. And it looks like they have pretty consistent dividends. They've got a large gross margin, and they have a great bottom line margin. So I look at this saying, okay, I feel very confident that this is probably something that's gonna stick around for a while, as long as the company keeps maintaining its current business. And that's great. And this dividend yield is 2.9%, actually lower than the overall SCHD dividend yield. But again, I encourage everybody, when you have a company that you like for the dividend, make sure they can support it. What I like to see, and this is not set in stone, but what I like to see is their dividend yield less than half of their 5-year average free cash flow? If it's less than half, it's probably something that can be supported. And on several videos in the past, we've seen companies where we go, how the hell did they have this dividend? And then sure enough, there'll be a cut to it at some point. Now, SCHD has been around since about 2011. And one of the biggest lies I've seen is that people who love SCHD will say, apart from 2023, SCHD has outperformed the S&P total return. Total return means including dividends. Guys, this is absolutely false. This is the total return for the S&P 500 and SCHD. SCHD is in purple, S&P 500 is in orange. 2022 right here, and 2023. All along the way from 2011, the orange is above the purple. Right here was the first time that it deviated. When was this? Roughly 2023. And guys, to their credit, this entire market has been lifted by basically the top 7 companies, which pay practically 0 dividends. So you're right. They are right when they say this. But at the end of the day, when they say things like SCHG has outperformed the S&P with dividends since 2011, that's just categorically false. That's just false. Even taking out, even here, it was even. Now, you might sit there and say, well, Paul, it's even. But guess what? The more dividends you receive, the more taxes you're paying. This does not include the tax liability that you're paying. And when it comes to compounding over long periods of time, it's about tax efficient compounding. It absolutely is about tax efficient compounding, which there's another misnomer out there. They'll sit there and say, well, if you reinvest the dividends, you will beat the S&P. Wait, what? First off, the S&P also pays a dividend. Yes, it's not as large, but you also have to pay taxes. You haven't even factored in the tax liability involved in there. That's why I just like to keep it simple and say, let's look at the total return. And since 2011, the S&P's total return is 350%. SCHD is 306. Now, with that said, do I believe this can go back to previous levels of being very close? I do. Because in this time period, it has been the crazy hype stocks that have driven the S&P's value. So they absolutely have a valid point there. Absolutely, and I don't disagree with that. And I don't disagree that it's potential that before taxes, the overall return, the total return of SCHD could exceed SPY and the S&P 500. But you cannot sit there and say that just because you're able to reinvest the money reinvest your dividends back into new shares, that automatically means no. What are you reinvesting? If you're reinvesting in something that's not beating the S&P, then you're not going to do as well. So then what's the reason? What's the reason they sit there and obsess over it? Well, guys, I still think it goes back to the whole idea. People have dividends and they feel like it's free money. It is not free money. It absolutely is not only not free money, it's also not even tax efficient. You're going to pay taxes again. This is what I always say in our videos. There are 5 things you can do with free cash flow. You can pay a dividend, buy back shares, pay down debt, reinvest back in yourself, like buying and putting more plants and equipment, hiring more staff, etc., or make acquisitions. Even though I love dividends, it's absolutely the last thing a company should do with their free cash flow. If they have no other choices of those other 4, then they should pay a dividend. And the reason being is, if a company sits there and they have an opportunity to reinvest their money at a 20% return, why in God's name should they pay a dividend? They should never do that. Ever. If they're paying 5% interest on a loan, why would they pay you a 2% dividend yield? If they're sitting there and they can buy back cheap shares, they should never, ever pay you a dividend. Buy back those cheap shares and give you, the investor, a bigger and bigger piece. That's how the compounding can beat the S&P. Not by paying a dividend, by the company buying back inexpensive shares. The real true way to create wealth is to find companies that can compound on themselves by reinvesting their cash flow back into their business, not by paying you a dividend. Okay, guys, let's go through an example here of an actual company, and we'll compare it paying out a dividend versus not. So let's say a company you have makes $1 billion a year. And let's say the bank account currently, we'll start from scratch, has $0 in it, and there's no debt. Okay, so $0 in debt. Now let's say this company sells on the market for 15 times its profit. So right now the company is a $15 billion company, and there's no money in the bank account, no debt. So legitimately you're just buying that cash flow in the future. Okay, now let's fast forward 10 years. They have no growth opportunities. They just keep the money in their bank account. 10 years from now, what happens? Well, the company's still making $1 billion, and you're going to pay 15 times that, so it's 15 billion. But over the last 10 years, they've put $1 billion in their bank account. So now they have an extra $10 billion in the bank account. What's the company actually worth now? 15 plus 10, $25 billion. Awesome. So the money's sitting in a bank account with the company, and that future stream of income is worth $15 billion to you. So that's a $25 billion company. Great. That's awesome. That's great. You've made a few bucks along the way. Actually, you've made no money except for the bank account money. That's it. And in this company, they weren't reinvesting, weren't able to grow the profit. You haven't made a great return. Okay. Now let's say instead, the company paid out the $10 billion in 10 years. They paid it all out to investors. So now at the end of 10 years, you have still a $15 billion company. The bank account's still zero. The debt's zero. And you might sit there and say, okay, let's say you paid no taxes. Now you have $10 billion in your bank account. So what's your company worth? Your total company is $15 billion plus dead $10 billion in your bank account, $25 billion. Same thing. No different. The money just shifted from the company to you. But now the IRS says, hey, wait a second. You got to pay 30% on that. 30% of $10 billion is $3 billion. You actually did worse. Now you have $22 billion. All dividends are doing are just transferring money from one bank account to yours, except now along the way, that little Uncle Sam says, pay up. Why? Because they want to. Even though it's double taxation. This $1 billion they made already paid tax on it, and now they're paying you out. You actually lost a few bucks here. Okay, let's take another company example. Let's say now, for example, that this company can now reinvest the money back in the business and generate a 20% return. So what that means is every year that they invest $1 billion, they can now increase that profit by 20%. Year one, they generate $1 billion. Year two, how much they reinvest it back in to get a 20% return. Year two, now they make $1.2 billion in profit. Awesome. What's that company worth now? $18 billion. Now they used the full $1 billion to reinvest to increase their profits. So they have no money in their bank account. They took the $1 billion from year one, reinvested it all to increase their profit by $200 million per year. Fine. Year two, they can now increase this 1.2, reinvest that at 20%. What is that now? 240 million. So you're at 1.44 billion in profit. Times 15, what's your company worth now? Let's do the math. 1.44 times 15. Now your company is worth 22 billion. Holy cow, guys. In a matter of 2 years, the value is now more than what you had at the end of 10 years after paying taxes on the dividends. Now they can reinvest it. Now they take their 1.44 billion and they invest and get another 20% increase. $288 million plus 1.44. Now the company makes $1.73 billion. You're going to get 15 times the profit for the value of the company. So 1.73 times 15. Now the company is worth $26 billion. Guys, now you might sit there and say, well, what companies have the ability to generate 20% returns? Well, small companies can. Companies that only make $1 billion. Large companies, it is harder. But that's why they should buy back shares. This is what people miss in the whole dividend conversation, the power of compounding. That is the big key here that really drives me nuts in the dividend community. All they're looking at is, I own a stock and it pays me out money. Great. I like dividends too, but it should be the last resort for the company. If the company is bad at investing their money, they should absolutely give it out to shareholders as fast as possible. Do not invest it, because most companies, they have a hard time with doing what? Reinvesting their money, because they want to look busy. Hey, I'm out there, I'm making acquisitions. Well, their acquisitions tend to be very, very stupid. So let's take this all the way into 10 years. Let's still assuming compounding of 20% per year. So 1.2 to the power of 10 times $1 billion. Now the company makes $6.2 billion at the end of year 10. Times 15 is basically 100, so $93 billion. So you took your 15 billion and made it 93 billion. Is that better than the other situation? Guys, that's the key here. Now, again, it is all about, can they really compound at 20%? Maybe, maybe not. But the point I'm trying to make is, let's assume a situation where the company pays out all of its profits and dividends, which the dividend holders would be like, this is awesome, this is great. Yeah, but your company's not going up in value because the profit's still the same. And even the profit grows 4 or 5% a year, your share price is only going to grow 4 or 5% a year. So they pay out 4 or 5% in dividends and they grow at 4 or 5% a year. You're still only getting an 8 or 10% return. Sound familiar? That's the market return. The question is, do you want to make it tax efficiently or not? Now you might sit there and say, well, Paul, wait a second. I have my money in my 401k, my IRA. It allows me to grow tax-free. Great. So to get rid of the taxes, you're still in the same boat as before. My whole point of this video is to sit there and say to you guys, don't just chase dividends. It isn't free money. Tell me they don't have other better options. If a company is selling for 6 times earnings, 6 times PE, stop that dividend. You'll see me in other videos say, why are they paying a dividend? Stop your dividend, buy back shares. You should absolutely be buying back shares. Give me a bigger piece of the company. Don't pay the profit out. Keep buying back shares so that I own a bigger and bigger piece of the company. That's a much more tax efficient and better way to reward me as an investor. Not paying out a dividend I got to pay taxes on, or even if I keep in my account, I can go reinvest back into itself. Remember, if your reinvestment rate is no greater than the market, then just put it in the market, in SPY. But don't fall into the trap that just because a company pays a dividend, it makes it a better investment. Because guess what? Companies know that, and that's why they pay a dividend a lot of the time. They want to attract investors. But you need to be the better investor. You need to be the smarter person out there who says, wait a second, is this the best use of your capital? Warren Buffett just said the other day, the day Berkshire pays a dividend is, in so many words, basically, that's not a good thing because it means we have no other reinvestment opportunities. It's the best investor all the time. He knows the best way to and at that point that happens, guess what happened to the stock price? It would plummet. And then you know what I'd say? Start buying back shares. Cancel the dividend, start buying back shares. Let me explain the benefits of the repurchasing of shares to increase your ownership as a better way of giving back to investors than sitting there and paying out dividends. Let's go back to the example. A company makes $1 billion a year, and we're going to pay 15 PE for it. That makes it a $15 billion company. All right, great. Now, let's say they have 1 billion shares outstanding. That means the price of each share is $15 per share. Very simple. $1 billion in profit, 15 times multiple, $15 billion value for the company, divided by 1 billion shares is $15 per share. Okay, year one, they make $1 billion. They're going to buy back all that money and buy back shares. So $1 billion divided by 15, they're going to buy back 66 million shares. Let's just round it to 65 million shares. Okay, 65 million shares. And let's say they do this, let's just skip ahead. Let's say they do this for 10 years. They take every single dollar and it's always selling for $15 a share. Make it very simple. In 10 years, they've bought back $10 billion in shares. So now they've bought back $10 billion worth of shares divided by $15 per share. How many shares they bought back? 666 million. So they went from 1 billion shares minus 666 to 334 million shares. But guys, remember, they made $1 billion. $1 billion that year divided by 334 million shares is $3 per share. Times a 15 multiple, it's $45 per share in value now. Remember our first example when they paid out all the money in dividends? This is how it's better to buy back the shares. Now your shares are worth $45 per share because you're $3 in profit. You're splitting the number of shares up that are splitting the profit. That's how you come. Guess what? This is all tax-free. Because it's just they're going to buy themselves back and your stock is going to go up tax-free. That's the big thing. This is why Congress wants to sit there and tax companies for share buybacks, because they think it's taking away from reinvesting in people. But they have to remember, sometimes the best thing to do is just buy back shares. You don't want a company to reinvest and build a factory or make an acquisition that's only going to make 4% for its investors. That'd be terrible. This is how you drive real value. You buy back shares. You keep buying back shares. Now, this is assuming the stock always stays at $15 along the way. What really happens is over time, they buy back more shares. The stock price should go up because now that $1 billion is split amongst less and less shares. So it'll become more expensive. So maybe instead, the stock's gonna be worth $30 or $35 a share. Still better than the 22 from before, still better than the 25 from before, and it's tax-free. This is why I want people to understand about investing. This is why I get so frustrated with the dividend community. I get it. I love dividends. Warren Buffett loves dividends. We all will take our dividends if it's the last resort. That's the last thing I want to be paid for. This is why I'd much rather have a company buy back their shares that they're selling for 10, 12, 15 times their cash flow and earnings if they're cheap. That's the key there, guys. Buy back those shares. So here's what you should do, guys. Very simply, and I know it's going to kill those dividend investors. I do give them credit. The SCHD followers love just reinvesting back in this and keep putting more money in there. But SPY and VOO gives you the S&P 500, 500 companies, some big, some small. The smaller ones will probably grow faster than the bigger ones. They do all the work for you. You can still reinvest those dividends automatically in your tax-free account, in any account you have. Pick indexes or ETFs that are more about, especially if you have a longer term outlook, that's smart buyers of value. You will do much better that way. I'd much rather have you do something like the little book that beats the market in your tax efficient account. Grow that money, compound that money at high rates of return. That's what really, really matters. And that works best with companies that are selling for low multiples that have a high return on the money invested in their business, either return on assets or return on invested capital. So just stick with these. I love the fact that the SCHD community loves putting money in every single day, every single week, every single quarter, and they should be commended for that. And that's what you should take away from that. And I do love dividends, but don't just buy because of a dividend. Don't just think just because you're getting a dividend, you're automatically winning. It's not free money, guys. It is never going, it's literally taking out of one pocket and putting it into another pocket. That's it. If I took $5 out of my left pocket and put it in my right pocket, I'm not richer. I'm exactly the same. And you have to remember that when you own a piece of a business through a share, you have that right to that cash in the account. That's why when they take it from their account and put it in yours, nothing has changed except you now owe taxes on that money. That's it. Guys, thank you very much for your time. Follow me on Twitter and tell me how stupid you think I am for doing this, or tell me how smart you think I am for doing it. Thank you very much.